Well, welcome to the Mutual Fund Show. I'm Neeraj Chow. The next 20 minutes, we'll talk about impact on mutual fund investments, current as well as future, as a result of the continuation of the RBI stance, arguably the language as well. The analog of tightening seems to be to move along with the Fed, and the markets are probably now pricing in the repo near 7%, and maybe a little over prepared for tightening. But instead of me trying to tell and second guess all of these things, let's get in somebody who's got an expert eye on this, Mr. Sunil Subramaniam. He joins in at an opportune time as we try and discuss the ramifications of what RBI's moves and language and therefore possibly future moves mean for mutual fund investing. Mr. Subramaniam, great having you. Hope all is well.
Hi, thanks, Rich.
So, Mr. Subramaniam, what did you make of the RBI's action and the language, and what does it mean for yields, for rates, and therefore for mutual fund investments?
So I think that first of all, we tend to look at RBI's thing from a narrow perspective of inflation versus growth, right? But I think it's important to bear in mind that RBI wears three hats, right? There's a monetary policy hat, there's what I would say interest rate hat, which I slightly differentiate from the liquidity aspect of monetary policy, and then there's a currency management hat. And overlaying all of this is the fact that they're the manager of the government's debt book, right? So they have multiple things to cater to. That's number one. The second thing is that we tend to equate RBI policy to Fed policy, right? RBI as a central banker and Fed as a central banker, or we tend to think that the Fed's action should be mimicked by the RBI, and we tend to wear the same lens. But there are two vital differences before I go and analyze this. The first difference is that the advanced countries are demand-led economies, where rates and liquidity directly transmit to the retail consumer and cause inflation or bring down inflation directly, whereas India is a supply-driven economy, right? In a supply-driven economy, interest rate policy has very limited role to play because the borrowing, the supply can affect interest rates on the borrowing by corporates, but not so much by the consumer at the ground end, because anyway, demand is also not the key. So the ability of interest rate policy to impact the GDP and inflation, right, is one. The second thing is the quantum of imported inflation in a country like India, which again is outside the purview of an RBI policy, right? No amount of policy interaction or intervention can do anything about oil being imported, food being imported. And the third and the most important thing here is that the Fed doesn't bother about currency, right? So RBI has to keep an eye on managing volatility in the currency. They don't target a currency rate, managing volatility, right? So if you look at it within the context of that, what the RBI did today, right, was, I think, a very good policy, very pragmatic in the sense that they know that 50 bips front loading of the hike, it's actually a 90 bips hike if you take between the last policy and this, right? So the front loading basically is to give them the room to boost growth when the supply side eases. So that's why they front load and not reacting. See, why the Fed hesitates to front load is front load directly hits demand growth. Are you right? When in India it doesn't. So there's no downside to front loading.
Sure.
It's only a sentimental thing. It's a visual thing that I'm front loading a hike. But at the ground level, you see maybe let's say if housing loan rates go up by 1% from the average at 6.5 levels they were pre these hikes to 7.5. What is the impact on the EMI for a customer, right? It's probably 100, 200 rupees per month on a 25, 30-year loan. So the RBI policy has more of a signaling effect rather than an actual reality ground level effect, right? And by signaling an early front loading and perhaps another 40, 50 basis points hike also, because they projected inflation at 6.7, which is way above their thing, but they left a small window for the last quarter of the year where they showed it coming below 6. So there is a hint in the policy that if monsoon is normal and we see food inflation, which is 45% of our CPI basket coming down, then RBI retains the desire to retain rates there or maybe even cut rates to support growth in the last quarter of the year. It is hidden within the language, but the way I see it is that's why he broke up the 4 quarters. So to me, it is very pragmatic in a country like India to front load, because Fed front loads it. He's hurting it where it hurts the most, right?
Sure.
He's hitting almost below the belt because directly consumers get affected. So that's one.
Mr. Subramaniam,
RBI laid off on the liquidity front. They talked about reducing accommodation over a multi-year time frame. So liquidity is also something that RBI eschewed a strong action today. Right?
Yeah, but the point being, Mr. Subramanian, the MPC unequivocal in no uncertain terms maintain, and I read it out, right? They've said that further monetary policy measures are necessary to anchor the inflation expectations, wherein they're also noticing that the upside risks to inflation have materialized earlier than anticipated, and they have been intensifying. So in some sense, in the near term, even if what happens in Q3 of the current financial year is a possibility, for now, it does seem like that it will be, as much as it may not have a bearing, but it will be heightened interest rates in order to anchor the inflation expectations. And there's a wide gap.
I'm not at all denying that. The fact that RBI's actions and commentary will lead to a rise in interest rate, I'm not questioning. I'm fully on that. But I'm just saying that that rise in interest rate in India, which is front loading, is not going to affect India growth so much.
Okay, fine. Fair
That's
point.
my point. I'm not denying that one. Second is also anchoring inflation expectation. Please read the word. It's not anchoring inflation. There is a subtlety to that language. Why? Because they are going by consumer expectation of inflation. They are doing a poll. So RBI is one reacting to already happening inflation for the last month, but also what consumers say they expect. So by hiking rates, they are talking about managing the expectations of people. So I think there is a point to be noted on that language, on the word expectation.
Got it, sir. Okay. So in which case, based on how you have read into and the subtleties that you've read into, Mr. Subramaniam, what is your sense of what should an average mutual fund investor on the debt side do as a result of the 2 actions that have been taken thus far by the RBI in the last 2 months and the language that they have used?
So there are 2 things. So the outlook, time frame outlook of the investor, right, for the debt allocations. I will put it as less than 3 years, more than 3 years, purely because of the taxation. It's driven by that, right? For a more than 3-year investor, please hear carefully what I'm going to say. He should invest only in liquid schemes. Okay, the reason I say that is in a rising interest rate scenario, right? Your reinvestment of the liquid corpus of the mutual funds every 30, 60, 30, 45 days will ultimately lead to them participating in the accrual over a 3-year time frame, whereas putting into a medium-term fund would mean taking mark-to-market losses. So I would argue that a 3-year investment in the liquid fund today would give a better return than an investment in a medium-term bond fund. Because the medium-term fund will buy 3-year paper today, which will hurt from a mark-to-market. So a 3-year plus investor should stick to short-term because the fund manager can redeploy at rising, and he will make the best post-tax yield for the 3-year outlook. Now you say, what about less than 3 years, right? If you have a less than 3 years, then I suggest an alternative product, which is named equity, but is debt. And that fund name is called Equity Savings Fund. Equity Savings Funds category offers an equity taxation because they use arbitrage as the balancing factor. They keep about 30% in equity and 30% in debt. And most equity savings funds tend to keep shorter maturity debt, thereby getting that accrual benefit on the debt side. Arbitrage should come to the aid both in terms of taxation as well as in terms of, in a volatile time, is when arbitrage tends to give a little bit of a better return. And the 30% equity component is generally multi-cap, flexi-cap. And in a volatile time frame, you can't say that, that allocation to equity will also aid. And the past track record of equity savings funds gives a high single-digit return when you hold for a longer period. And the reason I suggest this is, if any of the scenarios that I said played out, we have a very good monsoon, surplus food, inflation comes down, you might want to switch back to equity. Then from an equity savings fund, if you are going to do that after 1 year, you're only suffering 10% LTCG. And if you're doing it in 9 months, you're suffering only 15% LTCG. Whereas you make an allocation to a debt fund and you want to change 6 months later into equity, you're going to take short-term capital gains on debt, which is very, very painful and severe. So my suggestion there is to look at it from this perspective.
Last question, Mr. Subramaniam. What if it doesn't play out that way? And what if inflation actually goes out of control? In which case, would the equity savings fund or the equity savings category will still be the category that you would recommend? I mean, is there a downside to that?
Because the equity savings category, if you see, most of the offer document does have the flexibility to take the equity down to very low levels and substitute it with arbitrage. So if the situation pans out in a very bad way, these fund managers would, you see, I would also say dynamic asset allocation funds are probable, but dynamic asset allocation fund managers are always looking for an excuse to increase equity or reduce equity. They are not anchored towards the safety element, but they're looking at it as an opportunistic element. Whereas equity savings, by the name savings in it, is anchored around giving a reasonable return. So I would say that there is an ability to take down the equity, even down to 5 or 10% if need be, if the situation pans out in that way. That's where the flexibility comes in, because he will do 60%. He can put 50% in arbitrage and only 10% or 15% in equity to get that 65% equity component.
Extremely insightful. My final question to you, sir, and that is, what should a pure equity investor do currently?
Pure equity investor should allocate 70% to dynamic asset allocation funds and 30% to flexi cap funds.
Okay, so if somebody has existing allocations into, let's say, 100% into flexi cap, you recommend switching part of it into dynamic asset allocation funds?
Yeah, it depends on if you want to put people on an aggressive, moderate, conservative space. The moderate and conservative, I would say, do this. But for an aggressive investor, he can, as long as he's willing to wait out the volatility period, which an aggressive investor should be doing. He should be prepared for short-term periods of losses, right? Then I don't need to change his allocation. So since most investors are not aggressive, I recommend it as 70-30. But if somebody is already 100% flexi cap because he's aggressive mentally, he can continue. And the reason, just I round off by justifying this, is that if you see dynamic asset allocation, right, they are all also multi-cap, flexi cap in the equity part, right? And why I'm saying this is that the volatility that we are going to see, right, is essentially going to be FPI driven, international news flow driven, and hence, but the recovery that I see, why I recommend for an equity investor is the recovery is ultimately going to happen. Recovery will happen on a broader cap space because it's domestic sensitive, right? So flexi cap is a better option because the fund manager can flip between large, mid, and small as the situation pans out.
Got it. Mr. Subramaniam, thank you so much for taking the time out and speaking to us today. It was lovely getting your opinion.
Thank you. Thank you. All the best.
No, thank you so much. And well, very clear, Mr. Sunil Subramaniam, in his thoughts on what people should be doing and why. Now, what we will do is we'll try and supplement that by getting in somebody who's looked at all of these cycles very closely. Amol Joshi should be joining us any moment. And we'll try and ask him what is his thought with regards to this. And are there some categories or funds that he recommends within those categories as well? Amol, can you hear me?
Yes, Neeraj, I can.
Great. Amol, thanks so much for joining in. We're trying to, let me first take your understanding of what is your recommendation to your sets of clients if they needed some change. Maybe some of your clients are parked in a way that the allocation already takes care of this rising interest rate scenario. But
sure,
if there is some change that is required, where is that change and why is it that you're recommending that change within a debt fund portfolio of any of your clients?
So Neeraj, your first point is absolutely right. While making the portfolio at the design stage itself, we do take care of various aspects, including credit quality, including the investment horizon, and we match things according to that. But still, if I were to suggest fresh debt fund investments for fresh money that you want to allocate towards debt, my preference would be towards the roll down funds. We also now have target maturity, target date index funds, but roll down funds is something that I feel is better or more suitable. You have roll down funds from 6 months, from 1 year level, going all the way to 10 or even 20 years. Roll down funds, I think we have discussed in the past. These are funds who invest, these are funds that invest into a typical maturity, let's say a 5-year roll down fund will invest in debt papers that mature 5 years from now. Irrespective of where the rates go in the intervening period, rates might go up by 150 basis points and market cycle may turn after 2-3 years and then rates may come down again. But this fund generates the coupon on the existing 5-year debt paper that they have invested into. Now, as a fresh money, you have advantage. Over last several weeks or maybe a couple of months, inflation as well as expectations towards rate hike are building up in the market. And the yields have already hardened. So I would like to say that for a 5-year to 6-year highest credit or even SDL kind of a credit quality, you have yield of anywhere between 7.50 to 7.7, 7.8. That is extremely attractive yield. And new money, if you have a horizon of 4 to 5 years, should go into funds like this.
Okay. Amol, your answer may differ, and I'm hoping it does because it's lovely to hear contra opinion. But we had Mr. Sunil Subramaniam of Sundaram just before you, and he was saying that for people who have a time horizon of over 3 years, investing in your liquid funds might also be a good idea, simply because the fund manager will have the option to, or rather the leeway of not getting hit by the MTMs that come in if investing in long dated paper, and will be getting the benefits of the accrual. Now, what's your thought here?
So I think Sunil's point is valid, because few years back we had done this study, and I'm talking about 2017-18. And when during 2017-18 period, if you checked 10-year debt fund returns across categories, you could take liquid, you could take corporate bond, you could take dynamic bond, even barring some of the credit funds. Most of the funds, the median return, 10-year return was around 7%. Now, as you know very well, 7% liquid, I'm talking about several years back. However, at this stage, today, I slightly differ. It is true that as the rates go up, liquid papers, as they mature, those funds will be deployed in a higher yield, higher coupon papers. But I want investors to have a better outlook or better visibility, let me use that word, of the returns that they are likely to generate. And roll down funds offer you that. So I would not, for 3 years and more horizon, I would certainly not go with liquid funds. I would rather go with a roll down fund with a 3 to 4 year maturity, or I would go to a roll down fund that has 1 year roll down cycle, in which anyway you will get a benefit as good as liquid funds, but the yields will be slightly higher. Because as you know, liquid funds are constrained with the kind of maturity that they are invested into and several other factors.
Just one quick follow-up, Amol, here. For people who are hearing you and wanting to invest in those target maturity funds, let's say they have they are investing in a 4-year maturity fund, then
right.
Ideally they should invest with a mindset that they will not liquidate that money but stay till the end, right? Because you don't know what could happen in between now and those 4 years.
Neeraj, you absolutely said it. And here, debt and equity are not really comparable, and we always avoid comparing them. But now that we are talking about mindset, let me get equity into the perspective. Anybody during the bull market, everybody says that I have a long-term investment horizon. But when you see a 10, 12, 15% hit on your portfolio, suddenly the doubts creep in. That is the time when you have to tell yourself that over a medium to longer period, equities have delivered inflation plus inflation beating returns. Exactly same mindset you should have here as well. In case the interest rate harden very quickly here, let's say in next 1 or 2 quarters, then you would have the mark-to-market impact on your NAVs of a 4-year, 5-year duration fund. But you should also remember that 6 months hence, the 4-year duration fund has actually reduced to 3.5 years. So as the time goes by, the interest rate sensitivity goes down. That reduces the volatility, point number 1. Point number 2, no matter where the interest rates go, you still get the coupon, because did I mention that most of the roll down funds invest into highest rated, AAA rated, or even SDL or sovereign rated funds, sovereign rated debt securities. That's the second reason. No matter where interest rates go, you'll still get the coupon. Number 2. Number 3, which is again very important, that you have, and especially since you mentioned a 4-year fund, as you know, long-term capital gain, which is preferred rate compared to short-term capital gain, in equity kicks in 1 year later itself, within 1 year holding period. But in debt, it kicks in only after 3 years. So frequent churning does not really help you. Whatever return you have made for less than 3-year period will get added to your income, and it will get taxed at your slab rate, marginal tax slab rate. You will lose the indexation benefit. Since you are anyway not going to lose, even if the rates harden because of the target maturity funds or the roll down fund structure that we discussed over last 10 minutes, you are anyway not going to use, you better stay put and stay for tax efficiency as well as the returns that you started the expectation with.
Got it. One quick question. There are a lot of people who are DIY investors, right? So let's say somebody is convinced by the argument and wants to invest with a 5-year perspective.
Sure.
Right? How does he figure out what is the target maturity of the scheme that he's investing, that it is matching the 5-year number that we're talking about?
Right, absolutely correct. So Neeraj, we all know that there is a document called fact sheet. Fact sheet is the complete anatomy or structure or blueprint of any and every mutual fund scheme in India. Fact sheet is declared or published openly in a PDF format by every fund house every month. It is a regulatory requirement. You will actually have to go to the fact sheet of respective fund house. Within that, go to the debt section. And under that section, you will be able to see several funds, right from liquid funds all the way to dynamic bond, which are typically a higher duration, or even a 10-year GSEC fund. As the name suggests, it's a 10-year duration fund. So from a 90-day to 10-year, you will get entire information in the fact sheet of the fund house, and you'll have to take that effort to zero down on a suitable scheme for your investments.
Got it. Any funds or any schemes that you believe over 3 years are doing a good job on the debt side that people could consider?
Right. So
this may not be an exhaustive answer, by the way. I mean, I'm asking you to name 1 or 2. You could have more as well.
Sure, Neeraj. I understand. So I mentioned in the beginning that a 5-year or 5.5-year duration scheme currently has a YTM of 7.5 or more. 7.7, 7.8. So what the scheme that I had in mind was Nippon India Dynamic Bond. This scheme invests into SDL, state development loans, which is, you can treat them as a highest credit quality quasi-sovereign kind of papers. It currently has a maturity of 5.5 years, not maturity, I'm sorry, modified duration. I would say that the bracket that you mentioned, 4 years or more, if you have a 4 to 5 year kind of investment horizon, you can look at this scheme.
Okay.
Nippon India Dynamic Bond. You also have few other roll down schemes. If I had to talk about a scheme managed by IDFC, again, completely invest into 100% AAA maturity segment. IDFC Corporate Bond Fund is another scheme that you can look at.
Great. Amol, final question. What about people who want to invest for less than 3 years? What is the option, considering that the RBI may, or in all probability will, hike rates in the near term?
Okay, so why to reinvent the wheel? So even if you have a less than 3 year investment horizon, you can go with a scheme that has only 1.5 year of modified duration. Let me give out one such option as well. Again, from the house of Nippon India Floating Rate Fund. This fund currently has a modified duration of between 1 to 1.5 years. Within 1.5 years, the fund will roll down to kind of, but all the debt papers, existing debt papers will mature. What I'm trying to say is, it is not on the higher side, and despite of having a 1.5 year, which is comparably shorter investment horizon, you will still not get volatility even if the rates harden from here because of the roll down structure of the fund.
Great. Amol, always good having you, and thank you so much for joining us on such a crucial day, because a lot of people would be wanting to know what to do. So I'm glad you are here today.
My pleasure. Thank you so much for having me over.
The pleasure was ours, viewers. Thanks for tuning in to this leg of the Mutual Fund Show.